It seems like the markets are going nowhere but up this year, and as investors, naturally, we want to participate in that growth. So when stocks are doing well, we tend to see federal employees begin to move back into the CS&I funds, and this makes sense because you see other people invested in it and other people are making money, so you feel like the bear market is over and you want to invest again. But this behavior can actually ruin your retirement plan pretty fast if you're not careful. I'm going to explain why, and I'll talk about some character traits regarding the markets that could make this a pretty bad idea. And later I'm going to talk about how you can know when you should be changing your investment. So I really think you'll find this video helpful. But before I do that, if you're not getting our free newsletter, then you're really missing out. We send financial tips for federal employees on emails that we don't cover anywhere else, not in the blog, not in the videos. So if you're not already on that distribution list, we'll leave a link for you in the description, so make sure you sign up today. Now let's talk about why following the markets can really be a problem. You may or may not know this already, but the markets are always trading ahead of what the present day is. Now, what do I mean by that? If we look at a timeline where this is today, the present day, and this is the future, sometime into the future. And let's say we start to get information about the economy, such as the inflation numbers or perhaps the jobless claims numbers. This is all information that people use to judge the health of the economy and the markets. Typically, this is the thing that comes out at the end of the month where the figures come out and it's all in the news. Well, all of that is present day information. In fact, some of it is even from the prior month. And have you ever noticed that sometimes, even though there's bad economic news, the markets seem not to react at all? Why is that happening? Well, the markets are not really living in the present time. The markets are living all the way out into the future. How is this possible? Well, it's certainly not alive, but the fact is that the large financial institutions, like mutual funds or hedge funds, foundations, or etc., when they're placing their trades, they're looking out into the future. They're not making trades today based off of information that is current. So, for instance, let's say inflation is X, but in the future, they believe inflation will be Y. Well, the trades that they're placing today are not with inflation being X, it's with inflation being Y. And so this anticipating that occurs consistently in the markets, this is what drives the information and what drives the markets to behave the way they do. Now, the problem is that they are not always correct. The markets are not always priced according to what reality is. Think about 2022 or 2008, 2011, 2001. These are all moments in time when the markets realized, uh-oh, we were not correct about this growth. We anticipated incorrectly, and what you see is a huge decline in the markets correcting. And the problem is that as an individual investor, if you're making investment decisions based off of what you're seeing, you've already missed the boat. The markets adjusting today have already adjusted based off of what they believe the future holds, usually 3 to 6 months ahead of time. And this is why sometimes it feels like you're just chasing the markets and you just keep chasing the returns that are out there. So it becomes really hard to get in and out of the markets at the perfect time. Now, sometimes, of course, you might get lucky and you might actually get out or get in at an opportune moment. But mostly, by the time you're seeing the action in real time, you're seeing it in the news, you're seeing it reflect in current stock prices, that's because the trades have already been there months ahead of time, and now the growth is really coming to fruition. So a lot of people then try to get into the markets assuming, okay, well, I'm gonna jump on that train as it's moving. And that can be very dangerous, and we'll talk about why here in just a moment. But I want you to think about how many people are still very heavily invested in the G fund. Well, at the time of shooting this video, the S&P 500 is up nearly 20% from the bottom that it had last year. And the statistics are out there. Federal employees are just recently starting to invest their money back into the CS&I funds again. And what that means is if you didn't get invested back into the markets late last year, you actually missed a big part of that growth already. Sure, there's still a little bit to be had, but in just a minute, I'm gonna show you why that's dangerous to still be playing this game. So if you had to be invested in December, think about how you felt at that time. Were you ready to get back into the C fund or the S fund or the I fund last December? No, of course not. There was horrible economic news. People were very uncertain about what the future held, but you saw that fourth quarter of last year and the first 2 quarters of this year, the markets has been on a recovery. Whether it's sustainable is debatable because there are plenty of other issues in the economy. And folks, this is the challenge. If you wait until you feel ready to reinvest again, the markets are way ahead of you. And you might be getting back in at a time where it's starting to get risky once again. This is one of my all-time favorite graphics, and The blue line represents the markets going up and down and then up again. And the dots along the way are the emotions that investors feel along this roller coaster. As markets are going up, what do people start to feel again, right? We see this in the TSP by people reinvesting. We see optimism, we see excitement, we see exuberance. People are feeling great about their portfolios again after having had such a difficult year last year. But you'll recognize that this, at some point, we reach the point of maximum risk. Are we at this point yet? That's hard to tell. It's difficult to know when you reach that point, how much space between here and here, but understand that this moment is coming. And just before this moment is when many people are very excited about getting back into stocks again. Warren Buffett is famous for saying, and I'm just gonna paraphrase, but be fearful when other people are greedy and be greedy when other people are fearful. And of course, as the markets begin to drop in value, there's denial, fear, desperation, panic. This is how people begin to feel as the markets start to drop once again. And of course, the bottom of the markets last year, that's when people were feeling capitulation and panic. And you'll notice that, of course, that is the point of maximum return. If you got in at the bottom of the markets last year, you're up 20-ish% or whatever the S&P 500 is today if you were invested in the C fund. And folks, this is happening right now. Federal employees across America are going back in waves to the C, S, and I funds. Tens of millions, hundreds of millions of dollars pouring back into the stocks. Now, this is not me telling you you shouldn't be doing this. Please understand, it's impossible for somebody to know exactly how far the markets still have to rise. But you need to understand what is the risk in chasing the returns after much of the returns have already been given. And the big question is always, where is the top? Think about January of 2022. That was the point that your TSP has been at the highest value that it's ever been. Did you feel like going into the G fund then and pulling all the way out of the markets? No, of course you didn't. You were making tons of money by being invested. It wasn't until after you saw significant declines or started to see things fall apart that you really wanted to go back into the G fund and get out of the markets. So what are you supposed to do? How do you know when you're supposed to make changes to your investments? The only way to properly set your investment allocation is by going through the planning. Think about it. When's the last time that you got in a car and started driving before you even knew where you were going? That's backwards, right? First, you need to understand, what is the direction that I'd like to go in? Then you figure out, what's the path that I'm going to take to get there? Well, investing is very similar. You can think about where you are today and where do you need to be in the future? What are those timelines? When am I going to retire? How much money am I going to need? What am I going to use my funds for? Are my kids' education taken care of? And when you have those points out in the future, that's when you can begin to craft the pathway that you're going to take to get there. And you'll notice that there is a timeline between here and the future. Somewhere between now and the immediate future, hey, if you need money, this is money you need to have more conservative, because what happens if the markets are volatile? You don't want to risk selling when the markets have fallen. But other parts of your money can be growing for your future because you're going to need money in the future as well. You still have to have some growth because your wealth needs to be there to sustain you in the future so that you can stay retired. And here's the best part. When the stock markets do go up and down and up and down, you don't have to worry about interrupting your life because there's very short-term money that you've set up to not be very volatile. And you get to continue living your life not having to worry about the markets that have gone down. Because there are parts that will go down of your portfolio, but over time, if you're invested correctly, they will recover as the markets grow again. But you have to be careful that you're not chasing the returns just because you see them. If you do that, you could be at a point of high risk and come to a place where the markets begin to fall. And if all of your money is set up this way, then you're in for some big challenges. And folks, this is how the wealthy use the markets to help them live. They use it as a tool to help them accomplish their goals. They're not always seeking the best return or what's working right now. They set up a plan so that the rest of their lives is set up in a way that there's investments that are going to take care of them for each season of life, whether now, 5 years, 10, 20, or beyond. And so you really see that having a plan, you can invest according to that plan, and that's what gives you the best chance of staying successful throughout your retirement. So again, make sure you sign up for our free newsletter. I hope this was helpful to you, and we'll see you on the next one. Until then, stay wise and stay wealthy.